majoring in the banking and majoring in banking and the circle sector. CPA Samson is passionate at IFRS and international standards on auditing and a financial modeling trainer. He's a holder of a Bachelor of Commerce degree in finance from Kenyatta University, financial modeling and evaluation analyst from Corporate Finance Institute. He's currently pursuing masters in tax and custom administration. Also is a member of ISPAC. So allow me to welcome CPA Okari to share his experience and to speak to us this morning. Members, as I said, kindly be a good listener, have a pen and a paper, just note down whatever is not clear. CPA Okari will be able to respond after presenting. And I know it will be an interactive session, so just be attentive and be ready, because I know at some point you'll be picking delegates at random, so you should be ready to respond and share your experience. Thank you very much. CPA Okari, you can hear me?
Yes, CPA, I can hear you. Thank you very much.
Yes, welcome.
Thank you for this opportunity. I hope that my shared PowerPoint can be seen by everyone.
Yes, we can see.
Thank you very much for this opportunity. And it's my pleasure to take us through the theme of identifying and understanding sources of audit and business risks and the emerging risks due to the COVID-19 pandemic. I think much of the introduction has been done, and mine is to just begin by looking at what are our objectives for this session and proceed to look at the detailed discussion. Just a confirmation, I overheard you say from 9 to 10. Is it 9 to 10:30? Then the other, or what is the time that I have? CPA?
You can go up to 10. And you can go up to 10. Then we have 30 minutes from 10 to 10:30. We can have a question and answer section so that we break for our tea break.
Okay, thank you.
Yes.
All right, so by the end of this session, I would expect us to understand audit risk model and the sources of audit risk, understand business risk and its sources, appreciate the impact of COVID-19 on entities and on the auditor when conducting an audit of financial statements. Now, to understand audit risk and business risk, I would like to begin with what the overall objectives of the auditor are, as covered in ISA 200, the overall objectives of an auditor. And ISA 200 tells us that in conducting an audit of financial statements, the overall objectives of the auditor are to obtain assurance that the financial statements as a whole are free from material misstatement, whether due to fraud or error, thereby enabling the auditor to express an opinion as to whether the financial statements prepared or are prepared in all material respects in accordance with an applicable financial reporting framework. Now, that is to tell us that some of the sources of audit risk and business risk would be fraud and error, as we'll discuss in detail later on. And also, the applicable financial reporting framework is also a source of audit and business risk. But this will be discussed in detail. Then the other objective of the auditor is to now report on the financial statements and to communicate as required by ISAs in accordance with the auditor's findings. So the other source of audit risk, especially on the area of detection risk, is the auditor's report on the financial statements and communication as required by ISAs. Is the auditor going to ensure that they have followed every guidance that is provided by the International Standards on Auditing in preparing the report and making any communication relating to the report on the financial statements. That could be a source of risk, especially on the issue of detection risk. Are they going to apply the International Standards on Auditing, even the new ones that have been released or those that have been amended, in order to ensure that they have obtained sufficient and appropriate audit evidence upon which they'll base their opinion? Now, to start with the financial reporting framework, because we have mentioned about it as a serious source of risk or audit risk, just as an introduction bit of it, is that you find that one of the preconditions for an auditor to accept to conduct an audit of financial statements of an entity is that the financial reporting framework that the entity is going to use must be an acceptable financial reporting framework. Meaning that without an acceptable financial reporting framework, management does not have an appropriate basis for preparing the financial statements. And the auditor will not have a suitable criteria or will not have suitable criteria for auditing the financial statements. So management is preparing financial statements on an inappropriate financial reporting framework, and therefore the auditor will not have a suitable criteria to confirm that the financial statements are prepared in accordance with the applicable financial reporting framework. So the frameworks are general purpose financial statement frameworks and special purpose financial statement frameworks. But then the examples of such financial reporting frameworks would include, for example, the International Financial Reporting Standards that are issued by the ISB, the International Public Sector Accounting Standards that are issued by the International Public Sector Accounting Standards Board, the accounting principles that are issued by an authorized or recognized standard setting organization in a particular jurisdiction, provided the organization follows the established and transparent processes in deliberation and consideration of views from a wide range of stakeholders. So these are the examples of frameworks. But of importance is that before you accept the audit of financial statements, we have said you must look at whether the financial reporting framework is, or the financial reporting framework to be used is acceptable, because this is the primary source of the audit risk, that you have accepted to audit financial statements which have been prepared using an inappropriate financial reporting framework. So now the factors that you should consider in determining whether the financial reporting framework is acceptable would include the nature of the entity. For example, is it a listed entity? Is it a public sector entity? Or is it a not-for-profit entity? For as we all know, all entities that are public interest entities, for example, listed entities, must prepare their financial statements using full IFRS. So if a client has prepared the financial statements using another framework other than full IFRS, then that means that the framework is not acceptable. The other factor to consider is the purpose of the financial statements. And this will determine whether they are prepared for common financial statement needs of a wide range of users, or just the information needs of specific users, so that you can determine whether we should use a special purpose financial reporting framework or the general purpose financial reporting framework. Then we look at the nature of the financial statements. And this is whether they are a complete set of financial statements or a single set of financial statements. Also, we look at whether law or regulation prescribes the applicable financial reporting framework, so that we make sure that we apply the standards or the financial reporting framework when required by law or regulation. So having looked at just a small background of that, we now need to look at just the definition of the two terms, audit risk and business risk. And when you talk of audit risk, we are talking of the susceptibility of the financial statements or the risk that the auditor will express an inappropriate opinion when the financial statements are materially misstated. By materially misstated, it means there are errors, whether due to fraud or error, or the financial statements have not been prepared in accordance with the applicable financial reporting framework. Later on, we shall look at the audit risk model. Then when you talk of business risk, we are talking about a threat to the company's ability to achieve its goals, which means that you need to understand the business operations, you understand the business environment, you understand the industry in which the business operates, you understand the governance structures of that entity, you need to understand the various sources of revenue for that company, you need to understand whether the company is applying IT. For example, if it's using e-commerce platforms in making sales, and in understanding every aspect of that company or entity, then you would have understood what could be the sources of business risk. As the entity recently had some, for example, acquisition, has it entered into a new market? Has it developed new products? You need to do a thorough understanding of the business entity. But of course, the requirement of the ISAs is that you don't have to understand more than what the management understand the business, but you need to understand the business in order to assess whether there are business risks in terms of strategies and many other things that we are mentioning and we'll mention later on. But business risk can be strategic, financial, operational, legal, and other risks. So we'll start with the audit risk, and later on we'll discuss business risk, and then after that we'll discuss on COVID-19 and its impact on the audit. So starting with the audit risk, we know the audit risk model is that audit risk is a factor of inherent risk, control risk, and detection risk. Now, when you talk of inherent risk, we are talking of the susceptibility of financial statements to material misstatement, assuming that there are no related controls. Assuming that you have done a test of controls and have established that the entity's controls are not effective, then what is the risk that there could be material misstatements at both assertion level and at engagement level? That is what you call inherent risk. Now, when you talk of control risk, we are talking about the risk that material misstatements could occur and could not be prevented or detected and corrected in a timely manner by the controls that have been put in place. So in other words, we have controls in place, but the controls are not effective. In that, we then look at what are the chances that a risk or a misstatement could occur, and the controls that management has put in place cannot detect or prevent those material misstatements from occurring, or cannot correct them in a timely manner. Then we have detection risk, which is now in the hands of the auditor. Detection risk is the risk that the audit procedures that the auditor designs and performs will not be able to identify all material misstatements in the financial statements, which means that detection risk is within the auditor's ability to control. But the auditor cannot control inherent risk and control risk. So then, inherent risk and control risk are the sources of risks of material misstatement. And the detection risk is the risk that the auditor's procedures will not detect the material misstatements. So the auditor's objective when conducting an audit is to reduce audit risk to an acceptably low level to permit them to issue an audit opinion. And this will well lie in the detection risk, how you plan and perform the audit in order to reduce audit risk to an acceptable level. And that means the amount of work you need to do will mean that you need to make detection risk the subject of the formula. In audit risk is equal to inherent risk times control risk times detection risk, so that you look at how much risk are you of material misstatement are you ready to accept. Okay, so to understand the sources of potential risks of material misstatement, that is audit risk, we have said you need to understand the entity. And in understanding the entity, you also need to perform what you call preliminary analytical reviews, so that at least this can give you a view of what could be a risk in terms of the comparison of amounts for prior period and current period, or even budget versus actual results, so that you can identify if there is a risk or there's a potential risk of material misstatement, because at this point, it's a potential risk of material misstatement. Then you can also use RADA, which is what you're calling risk assessment data analytics, because we now need to use technology in conducting audits, and risk assessment data analytics could be one of the tools that you can use to identify if there could be potential risks of material misstatement. We also need to look at entity level controls. And this could be the control environment, the entity's risk assessment process, the information and communication, and monitoring of controls. Of course, these are the components of internal control of an entity. So we'll need to look at them in order to determine whether there is a potential risk of material misstatement. So once we have done this, because these are risk identification procedures, we can then identify whether there is a potential risk of material misstatement. And on that, we then need to determine whether that potential risk of material misstatement is either at engagement level or it is at assertion level. At engagement level, it means it's pervasive to the financial statements. But at assertion level, we'll have to look at the assertions. Is it completeness of expenses? Is it existence of some asset? So we have to determine whether the potential risk of material misstatement that we have identified is at engagement level or at assertion level. Of course, the components of internal control we've said will help us to understand whether there are risks of audit. For example, the control environment, in terms of the attitudes and willingness of the management and those charged with governance to ensure that the controls are in place and are effective. If they're not willing, there is a high risk of material misstatement. If they are willing, then the risk might be lower. We look at the entity's risk assessment process. If there's a process in place, at least we might find that there are some risks they have identified. And the risks of material misstatement may be lower. But if there is no risk assessment at all, then it means that risks of material misstatement for the auditor are high. We look at information and communication. We look at the control activities that are relevant to the audit. In other words, we call them CARA, control activities that are relevant to the audit. For example, we look at revenue. What are the controls in the revenue cycle that are relevant to the audit? Is it ensuring that all cash received for cash sales is banked on a daily basis? Is that a control activity that is relevant to the audit? What about bank statements or bank reconciliation? Is it ensuring that cash and bank, there is bank reconciliation on a monthly basis, which is reviewed and approved? Is that a control activity that is relevant to the audit? So we identify all those and check whether there are any risks in that area. We look at what is the policy of the company vis-a-vis what's the best practice and what does the company normally do. Are there any lapses in terms of, for example, bank reconciliations were not done the whole year because there was COVID-19? What about monitoring? Are we monitoring the controls from time to time, or there are no monitoring and evaluation or remediation processes within the entity? So those controls or the internal control components can help us in identifying whether there are any risks. If we don't monitor the performance of the controls we have put in place, so that you can check whether there are any that are outdated, which need to be updated, or there is need for us to get better controls because the controls we have put in place are no longer working, then it means that risks of fraud and error will be high, and therefore risks of material misstatement will be high. Now, if we have a small entity which does not have audit function, do we have a risk? Does it give rise to an RMM? What about management overhead? That's just a question. We have a small entity that does not have an internal audit function. Could that lead to or give rise to an RMM? Or do you only consider large-sized entities? Now, to obtain an understanding of the entity and therefore obtain an understanding of the internal controls in place, and therefore identify whether there are any risks of material misstatement, we need to do visits to client premises, which was very difficult during the COVID-19 pandemic. And we'll see later on how that poses a danger to the audit. We need to review minutes. We need to conduct interviews with management experts. We can make discussions with management and staff. We can observe whatever is being done by the entity. And we can also review internal audit reports if the entity has internal audit function. So by obtaining the understanding, we can then be able to identify if there are any risks of material misstatement. Of course, we have said that we look at whether the risks or the potential risk of material misstatement is at engagement level. And if it's at engagement level, it is pervasive and it's not specific to certain parts. It impacts overall behavior and testing. If it's at assertion level, then we will look at classes of transactions, account balances, or disclosures. And we are looking at the various assertions like completeness, existence, accuracy, valuation, presentation, and so forth. Now, we first identify the potential risks of material misstatement, as we've said, and determine whether it's at engagement level or at assertion level. So we have identified them and determined whether they are at engagement level or at assertion level. And after that, we need to assess whether they are significant risks of material misstatement or whether they are just normal risks of material misstatement. Even at assertion level, we also need to look at whether there are significant risks of material misstatement or they are just normal risks of material misstatement. And after that, we now need to respond to those risks that you have assessed. We can have financial statement level responses or actions, and we can also have assertion level responses, which could include the reliability factor, the audit or reliability factor. Now, what conditions or events can indicate that there are potential risks of material misstatement? And remember, up to this point, we are only talking about potential. We have not discussed them and agreed that these are risks of material misstatement, which are actual. They are potential because we are identifying sources of risks of material misstatement. So the conditions or events that can indicate potential risks of material misstatement could include operations in regions that are economically unstable. For example, countries with significant currency devaluation or highly inflationary economies. Is the entity operating in regions that are economically unstable? That could be a potential risk of material misstatement. We look at operations exposed to volatile markets, for example, futures trading or trading in derivatives. We can look at high degree of complex regulation. If the entity is operating in an environment where there is a high degree of complex regulation, that could be an indicator that potential risks of material misstatement could exist. We also look at going concern and liquidity issues, including loss of significant customers, as a potential indicator that risks of material misstatement could be present. Constraints on the availability of capital and credit, changes in the industry in which the entity operates, changes in the supply chain, there are quite a number of them, developing or offering new products or services, or moving into new lines of business, because this is an area that the entity has never been before. We have to look at what are the risks of new product development and what are the risks of new business line operations. Expanding into new locations can also be a potential risk of material misstatement. We also look at indications that there may have been cyber incidents. Could there be cyber attacks? I think the speaker after me will look at matters technology, and now we're looking at cyber attacks. Has the entity had any cyber incidents, which could mean that the entity has a potential risk due to the use of technology? For example, if it's a bank, has it had any cyber attacks where customers' funds have been siphoned out of their accounts? Therefore, which means they need to look at the controls they have put in place. The conditions continue. We look at the changes in the entity, such as large acquisitions or reorganizations or other unusual events. So for example, on acquisitions, we are looking at potential risks of material misstatement in terms of, for example, goodwill on acquisition. So you're looking at reorganizations and other unusual events. In the reorganizations, are we discontinuing any of the business lines or operations, which could mean that some assets could be impaired under IAS 36? Are there any unusual events that have occurred in the business that could lead to some potential risks of material misstatement? We also look at entities or business segments likely to be sold. We look at complex alliances and joint ventures that the entity may have. Lack of personnel with appropriate accounting and financial reporting skills is a potential risk of material misstatement. Changes in key personnel, including departure of key executives, could be a source of potential risks of material misstatement. Deficiencies in internal control, especially those not addressed by management, which is why we said we need to understand the internal control, and we have looked at the components of internal control. We have incentives for management and employees to engage in fraudulent financial reporting. For example, those bonuses that are paid based on performance. Inconsistencies between the entity's IT strategy and its business strategies could be a source of potential risks of material misstatement, and changes in the IT environment, including, for example, an entity changing from one accounting software to another. That could be a source of risks of material misstatement, because we have now to look at whether the balances from the other system have been accurately and properly transferred to the new system, and whether the employees have been trained on how to use the new system, and whether the entity has made sufficient plans on how to migrate from the old system to the new system, or are they just moving, today we were in QuickBooks, tomorrow we are in Tally. We also look at installation of significant new IT systems related to financial reporting. Changes in IT environment could also include starting to make online sales, that is e-commerce platforms. There are quite a number of them. Inquiries into the entity's operations or financial results by regulatory or government bodies could also be an indicator that there could be potential risks of material misstatement. If there could be inquiries into the entity's operations, for example, by KRA, or by the Capital Markets Authority, or by the Central Bank of Kenya, or other regulatory or government bodies, that could be a potential risk of material misstatement. We also look at past misstatements, history of errors, or a significant amount of adjustment at period end, which could also indicate that that is a potential risk of material misstatement. Significant amounts of non-routine or non-systematic transactions, which could include intercompany transactions, and large revenue transactions at the period end, could also probably indicate potential risks of material misstatement. Transactions that are recorded based on management's intent, for instance, debt or refinancing, assets to be sold, and a classification of marketable securities. In other words, we are looking at those transactions that require management's intent, or they are just transactions that are recorded based on management's whimsical decisions. That could be a potential risk of material misstatement. Then application of new accounting pronouncements. For example, we have IFRS 9, IFRS 15, IFRS 16, and IFRS 17 as new financial reporting standards. And these could pose risks of material misstatement, because you'll find a client has reported the 4 categories in IAS 39 of hired to maturity, talk about available for sale, talk about loans receivables as the classification of financial assets in their books, and they're saying they have complied with IFRS 9, which requires them to have them at amortized cost, fair value through profit or loss, or fair value through other comprehensive income. That could be a source of potential risks of material misstatement. Again, understanding and applying the new standards has posed a serious challenge, and the auditor has to look at whether that could be a source of potential risks of material misstatement. Accounting measurements that involve complex processes could also be a significant or a potential risk of material misstatement, and also look at events or transactions that involve significant measurement uncertainty, including accounting estimates and related disclosures. Those could be sources of potential risks of material misstatement. We can have pending litigation and contingent liabilities. We can have the entity issuing or investing in crypto assets. The cryptocurrency assets could be a source of risks of material misstatement. Now, having said that, now we have also said that we are looking at no more risks of material misstatement and significant risks of material misstatement. And when you say we are talking about significant risks of material misstatement, we mean that these need additional work to be done, as we'll see later on. So we have looked at what are the conditions or events that can indicate potential risks of material misstatement. And now we want to look at what can help us determine whether the risk of material misstatement that we have identified is significant. And in this case, we need to consider whether it's a risk of fraud. Whenever it's a risk of fraud, according to ISA 240, this is a significant risk of material misstatement, which needs additional consideration or additional audit work, whether it's related to recent significant economic, accounting, or other developments, and therefore requires specific attention. We also look at whether the transactions involved are complex or the complexity of transactions. Also look at whether it involves significant transactions with related parties, because this can be a source of significant risks of material misstatement, including whether the transactions were carried out at arm's length and whether there's need for us to have a transfer pricing risk. Then we also look at the degree of subjectivity in the measurement of financial information that's related to the risk, especially measurements involving a wide range of measurement uncertainty. And we also look at whether it involves significant transactions that are outside the normal course of business for the entity, or that otherwise appear to be unusual. That could be a significant risk because this is a transaction that is outside the normal course of business for the entity. That's according to ISA 315, paragraph 28. Now, having identified the risk of material misstatement, that means it's no longer just a potential risk of material misstatement. We need now to have an engagement team discussion. And in the engagement team discussion, we need to look at the likelihood and the magnitude of that risk of material misstatement. Because now we have established that based on our knowledge at the point in time, we believe this could result in an assessed risk of material misstatement, either due to fraud or error. Now we need to look at engagement team discussion level, we need to look at the likelihood and the magnitude of that risk. And if we find risks that you can see 1 and 2 at this quadrant here are risks that need special audit consideration. And therefore, there will be significant risks of material misstatement because they are risks with a high magnitude and the likelihood of them occurring is very high. So we call them significant risks of material misstatement. And this needs special audit consideration. All risks of material misstatement need to be worked on, but significant risks of material misstatement will need special audit consideration. Now, we have said that understanding the entity and its environment will also help us to understand whether there are any risks of material misstatement, which means that on audit risk, at least we have discussed what audit risk is and what are the components of the audit risk and how can you identify any potential risks of material misstatement. What indications or conditions can show you that there could be potential risks of material misstatement? Then you need to have an engagement team discussion and establish whether there are actual risks of material misstatement. After that, you need to determine whether there are significant risks of material misstatement. Having determined that and done special audit consideration, we now need to look at, as much as it will also involve audit risk, we are looking at now business risk. And as much as you need to do an understanding of the business and its environment to also understand the audit risks, we also understand business risk from that understanding. So we are saying in this case that the auditor is required to perform risk assessment procedures and to obtain an understanding of the following aspects of the entity and its environment. And remember, we said you do not need to have an understanding to the level of how management or those who operate the entity have, but at least you need to have an understanding of the entity's organizational structure, the ownership, governance, and its business model. And you need to document that. You need to understand the industry, the regulatory, and other external factors so that this can be understood as the sources of business risk as well as audit risk. The industry in which an entity operates can be a source of business and audit risk, the regulatory environment, and other external factors. You need to understand the measures used internally and externally to assess the entity's financial performance. You will need to understand the applicable financial reporting framework and the entity's accounting policies and the reasons for any changes thereto, because that could also as well be a source of audit and business risk. We have discussed about the financial reporting framework before, so we'll not discuss in detail about it again. You also need to understand how inherent risk factors affect the susceptibility of assertions to misstatement and the degree to which they do so in financial statement preparation in accordance with the applicable financial reporting framework. Once you've performed risk assessments in A and B above, this will assist you and the engagement team in understanding the events and conditions that are relevant to the entity. That is, the current period business risks can be understood from understanding A and B, understanding the aspects in A and B. And it can also help you in identifying potential risks of material misstatements. So to understand business risks, you need to carry out what we are saying over here. You understand the organizational structure, ownership and governance, business model, and whether we have integrated the use of IT. For example, e-commerce platforms. We need to understand the industry in which we operate, the regulatory and other external factors. We need to understand how performance is, or financial performance is measured by the entity. We also need to understand the financial reporting framework and the accounting policies of the entity. And we also need to understand the inherent risk factors in the preparation of financial statements in accordance with the applicable financial reporting framework. This will help us in understanding business risks. Now, an auditor's knowledge and understanding of the applicable financial reporting framework will also help us in developing initial expectations about whether one or more inherent risks of material misstatement may exist within the entity's business process and related financial statement areas and assertions. For example, understanding that the entity is using full IFRS will bring to the fore the new standards that have been issued. And the auditor will have an initial expectation that the entity may have not applied fully the new standards like IFRS 9, IFRS 15, IFRS 16, or IFRS 17 if applicable to that entity. And that could be an inherent risk of material misstatement. Now, the auditor's risk assessment procedures to obtain the required understanding may be less extensive in audits of less complex entities and more extensive for entities that are more complex. Therefore, it's a matter of judgment. You will not do an extensive understanding of the entity and its environment for a small entity as opposed to doing it in a large-sized entity or an entity with complex operations. When understanding the entity and its environment, you need to understand the business model because this is where the business risks will emanate from. And in understanding the entity's business model, we need to understand the entity's objectives, the entity's strategies, and the business model, which will help the auditor to understand the entity at a strategic level and understand the business risks the entity takes and faces. So that we can understand the business risks that the entity takes and it faces. And in this case, understanding of the business risks that have an effect on the financial statements will assist the auditor to identify risks of material misstatement. Since most business risk will eventually have financial consequences, thereby an effect on the financial statements. That according to ISA 315, paragraph A61R. So an auditor needs to understand the business model, and this will enable them to understand what are the objectives of the entity. Is it meeting its objectives? What are the strategies? and what business model is the entity using in making its operations. And this will help us identify risks of material misstatement. Now, business risks that can increase the susceptibility to risks of material misstatement and therefore need to be looked at by the auditor keenly may arise from a number of sources. This could include inappropriate objectives or strategies, ineffective execution of such strategies, or change or complexity. A failure to recognize the need for change may also give rise to business risk. And this could be, for example, from the development of new products or services that may fail, the market which, even if successfully developed, is inadequate to support a product or service. That means we have limited demand or inadequate demand. Then we also look at flaws in a product or service that may result in legal liability and reputational risk because we are developing new products. We also look at incentives and pressures on management that may result in intentional or unintentional management bias, which may affect the reasonableness of significant assumptions and expectations of management or those charged with governance. So you're looking at whether there are any incentives that may make management or the employees to make intentional or unintentional biases. Now, what matters should the auditor consider when obtaining an understanding of the entity's business model, its objectives, its strategies, and the related business risks, which may bring about risks of material misstatement? The auditor should focus on the industry developments, like the lack of personnel or expertise to deal with changes in the industry, new products and services that may lead to increased product liability, expansion of the entity's business and demand has not been accurately estimated, look at new accounting requirements where there has been incomplete or improper implementation of the same. The auditor should look at regulatory requirements resulting in increased legal exposure. For example, the requirement that the SACCOs with or the SACCOs with 100 million and above in capital to be regulated by SASRA, or the requirement that the digital lenders should now be regulated by the CBK, should be a regulatory requirement that will lead to increased legal exposure for such companies via auditing them. We look at current and prospective financing requirements. For example, loss of financing due to the entity's inability to meet requirements. Use of IT, such as the implementation of a new IT system that will affect both operations and financial reporting. And look at the effects of implementing a strategy, particularly any effects that will lead to new accounting requirements. So those are some of the matters that you need to understand or put into consideration when identifying business risks that may have a bearing on risks of material misstatement on the financial statements. Examples of matters that the auditor may consider also will be on business operations. This will be the nature of revenue sources. You look at the products or services that the entity has and the markets in which it is, including involvement in electronic commerce, such as internet sales and marketing activities. Remember that there's an audit standard that specifically deals with e-commerce activities. It's called IAPS, relating to e-commerce activities because of the challenge or the risk they pose on the audit. We also look at conduct of operations. For example, the stages and methods of production, activities exposed to environmental risks. We look at alliances, joint ventures, and outsourcing activities, which may pose a risk. That means you're also looking at service organizations and the use of service organizations under ISAs. We look at geographic dispersion and industry segmentation of that entity. Look at location of production facilities, warehouses, and offices, and location and quantities of inventories. You look at key customers and important suppliers of goods and services, employment arrangements like union contracts, pension, and other post-employment benefits. You look at stock option or incentive bonus arrangements, government regulation related to employee matters, and many others. You also look at the research and development activities and expenditures, whether they could pose any risk of material misstatement. You look at transactions with related parties because we've said they also pose a risk of material misstatement. Under investment and investment activities, you also need to look at planned or recently executed acquisitions or divestitures and look at the risks that they may pose to the audit. You should look at investment and dispositions of securities and loans. Look at capital investment activities of the entity. Investments in non-consolidated entities, including non-controlled partnerships, joint ventures, and uncontrolled special purpose entities could also be a risk of material misstatement. The financing and financing activities, the auditor will also need to look at the following. Look at ownership structure of major subsidiaries and associated entities, including consolidated and non-consolidated structures. The auditor needs to look at the debt structure and related terms, including off-balance sheet financing arrangements and leasing arrangements. We'll need to look at beneficial owners, for example, local, foreign, business reputation and experience, and the related parties. And we need to look at use of derivative financial instruments and the risk they pose to the audit of financial statements. Now, we now need to look at the implications of COVID-19 on the audit of financial statements. If I'm too fast, you can let me know. So we have looked at business risk and we have looked at audit risk. It's quite, you can see it's there's a lot of information that we can share in such a short period of time. So I want us to move to something else. The implications of COVID-19 pandemic on the audit of financial statements. Of course, the first thing I'm looking there is timing of audits and what implications that has. And the first I'm talking about is accounting transactions for some or most of the 2020 financial year are more likely to have been prepared when the entity was operating under COVID-19 conditions. That means entity staff were working from home, a lack of access to premises or data, increasing levels of staff illness or absence. That is a fact that we know. If that be the case, what could be the impact of these on the entity itself? Then we look at the impact on assurance or on audit. This may mean that entity staff are working under increased pressure, additional workload, or following changed procedures, which may have led to internal controls being overridden or applied differently or incorrectly. That is a source of risk or audit risk, that the internal controls may have been overridden or applied differently or incorrectly. Number two, entity management decisions, estimates, and other judgments may have been made using more limited information or information that changed or became quickly out of date because of the pandemic. And that means that that is a risk in terms of estimates. We need to look at the estimates in detail. These circumstances, combined with reduced entity staff capacity, poor segregation of duties, untrained or new staff working on unfamiliar tasks, other entity staff working unsupervised or without preventive or detective controls operating effectively, could have increased opportunities for fraud and error. So you're looking at, there could be a possibility of fraudulent activities having taken place or some errors having been made. Now, we still look at the entity's impact. And here we are looking at, with management and those charged with governance, focused on the immediate issues of the entity's financial and commercial survival during 2020, they may have paid less attention to fraud risks. Above disruptions and compounded in group audits with multiple components, some of which may be operating in different jurisdictions. And that may mean they may have been affected by COVID-19 at completely different times and to varying extents. Reductions in personnel with financial institutions, suppliers, or customers may have an impact on the ability of those entities to conduct operations effectively, which may affect their ability to respond in a timely manner to confirmations. What is the assurance impact of those things now? One, we may identify increased risks of errors or fraud, both in routine transactions and in year-end adjustments or accounting estimates, which means we now focus on looking at whether there are any risks of errors or fraud, looking at routine transactions, journal testing throughout the year, and also looking at any year-end adjustments or accounting estimates that may have been made. Our ability to access information that is produced by the entity on a timely basis for single entity or even group audits may be more affected by COVID-19 than in 2020, which may require us to be more engaged in communications with the entity personnel and component auditors. Again, where third parties have faced accounting record disruption or there is lack of personnel, this may impact our ability to perform procedures such as confirmations, which may lead us to apply alternative approaches in obtaining sufficient appropriate audit evidence. This could include online account reviews, reconciliations of supplier statements, many others. And this may be time-consuming and less reliable than confirmations. What about on financial health of entities subject to audit or review? What has COVID-19 or how has COVID-19 pandemic impacted on the financial health of entities subject to audit or review? Now, the first thing would be, there could be uncertainty about the immediate outlook for any entities in 2021, and the sectors within which they operate remains high. And government assistance programs may have wound down, and governments may try to reduce public spending. Thus, entities may be operating in worsening economic conditions, reduced support payments, reduced market demand for continuing lockdowns, supplier disruption, and many others. What does that mean? We also look at other impacts. There could be increased pressure to meet targets by the employees, especially given the declining financial situation in 2020. There may be more opportunity for entities to accelerate write-offs to reduce taxes and generate a bigger perceived recovery in future years. That may lead to increased risk of fraud or other irregularities. There could be increased liquidity issues with the entities unable to meet liabilities, especially if government assistance programs impact liquidity or lenders start to limit access to credit facilities. And of course, they did that because they were not issuing so many loans to people during the COVID-19 pandemic, and that could lead to liquidity issues. Poor availability of staff, closure of premises, and poorer cash flows may lead to reduced budgets for security personnel or procedures, which may have led to weakened security over physical assets during 2020. And therefore, there would need to be more physical inspection of assets to check whether the assets in the books or in the asset register are still in the company's hands. There may be penalties, fines, or repayments, which may be imposed this year on entities that may have made improper claims, like tax rebates, government assistance, or did not fulfill their required obligations for the assistance. That is a financial impact. And that means management should be addressing the impact on the entity financial health in the preparation of the financial statements. And in particular, they need to make appropriate judgments related to, number one, going concern. Is the entity still a going concern? Number two, they need to look at estimates. They need to look at error, because the full impact of having personnel operating remotely, potentially with less supervision and training, in an unprecedented set of circumstances, and with limited access to on-site resources or accounting records, is likely to have increased the risk of errors being made during the year 2020. There could be also fraud, as we said, because of the impact of poorer control environment, key staff and management who may have been absent, reduced segregation of duties, the potential use of workarounds. This could have led to increased opportunities for individuals to commit fraud. And this could have led to declining financial health of the entity. There could be also an issue of non-compliance with the laws and regulations in terms of accruals and provisions as well. And this could be because there were new laws that were enacted in the year 2020, which needs to be complied with. And maybe the entity may have not made provisions for the amounts they need to pay or accruals. And they may also, in that line, there were changes in tax rates due to the tax reliefs. And you might find that the entity did not compute the PAYE and other taxes that they need to have paid correctly based on the tax relief that was issued by the government. There's also an issue of accounting for government assistance, whereby management will have had to make decisions about how to account for government assistance, be it as loans repayable at future point in time or non-repayable, and their initial decisions may have been incorrect, including whether they were eligible to get that assistance, or further guidance that may have been issued by the government may indicate subsequently that the accounting treatment of the assistance needs to change. And on that note, then the auditor will also need to be on the lookout. Like that, the next thing now we look at financial health and how it affects the auditor. That's the assurance impact. The first thing will be identify additional risks, including error and fraud risks, which require us to plan additional audit procedures responsive to those risks or seek alternative evidence that is more persuasive. We will need to design audit procedures to focus on those areas that were most susceptible to error and fraud. For example, establishing which parts of the accounting function were most impacted, the time frame or where controls were overridden. We also need to consider whether procedures using data for comparison and analysis purposes, like substantive analytical procedures or data analytic tests, may provide lower levels of assurance, and therefore look for other tests that may enable us obtain sufficient and appropriate audit evidence. We'll also need to seek to understand what management and those charged with governance have done to prevent or detect errors and fraud being made by the entity staff and management in 2020. We need to remain alert and apply heightened professional skepticism, for example, in relation to the information that is produced by the entity, management explanations, rationale, and items within the financial statements that are based on judgments. We will also need to look at jurisdictional or ethical requirements to identify and potentially report non-compliance with laws or regulations, which may increase this year. For example, entities have been operating in breach of COVID-19 laws or regulations, or even asking personnel to work when they should not be doing so. Now, we should also consider unusual or non-recurring amounts or disclosures being made in the financial statements, which can affect how materiality is set. Because there could be non-recurring amounts that have been incurred and disclosures thereof. For example, the purchase of PPEs for COVID-19 pandemic. We also need to apply specific materiality to additional or different classes of transactions, account balances, or disclosures as a result of changes or additional disclosures. We need to look at whether there is need for us to apply specific materiality to those classes of transactions, account balances, or disclosures. This could be as a result of the changes that have occurred or the additional disclosures that we'll need to make. We now need to look at whether we need to change component materiality or those components that we had initially identified as being significant in group audits. And we also maybe need to redesign group audit strategy. And they need to ensure the nature, timing, and extent of audit procedures will provide the auditor with evidence needed for group audit purposes. So that is a brief discussion on the audit business risks and the implications of COVID-19 on the audit of financial statements. And to that end, I will conclude at that and take it back to CPA so that I can now be able to respond to any queries that have been asked. So in summary, we've looked at what the audit risks are and what sources there may be. We've looked at business risks and how they can be identified. And we've looked at what the COVID-19 pandemic impact may have been on the entity and on assurance or on the audit of financial statements. Thank you, CPA.
Thank you. Thank you. Thank you very much, Asbiokari, for the good presentation. And for sure, you've covered a lot of areas that as auditors need to consider and see how to improve. Delegates, it's now your time to let's share experiences. And kindly, you can post your question under the Q&A section so that you'll be able to respond. Post your question under Q&A. You can call was here the Badari. Members, any query? I can see members asking whether we are sending the presentations. Yes, we will send after the training tomorrow. This one will be sent to your emails. Any question, clarification before we close? We have 182 participants, so I don't know whether all of us, we don't have any clarification.
Okay, maybe as you look at whether they are asking any question, I think this one is a direct one, a direct message to me.
I can see questions, yes.
CPA Francis Langat is asking, how is risk assessment affected by the pandemic and how do we navigate around it? I think I have mentioned a lot about the pandemic and how it affects risk assessment, because we have said the risk increases because of the pandemic in terms of looking at the financial health of the company and looking at what may have happened during the year 2020, because that's what you're going to audit. And you have said that there could be high risk of fraud, the high risk of errors which may have been committed, by the staff because of the lax or because of the relaxation of controls, supervision, and because of maybe some new employees who are given tasks that they have not been familiar with. And because of that, there could be many errors that the auditor needs to look at. And you have also said that in terms of fraud, we need now to look at any adjustments that may have been made in the books, including the year-end adjustments, to check whether there could be any risks of fraud and error. So I think you can go ahead, and if there's another question asked, but I think this is what we have mentioned in the last session about the impact of COVID-19 on the audit. And we have said you need to identify additional risks, including risks of error and fraud. You need to design audit procedures to focus on those areas that are most susceptible to error and fraud. We have said that you must remain alert and apply heightened professional skepticism. We have said you need to seek to understand what management and those charged with governance have done to prevent or detect errors and fraud. And we have also said that you will need to look at whether the entity may have not complied with laws and regulations. Thank you. Maybe another question?
You can access the chat section. Are you able to the chat section, Secretary?
Come again?
Are you able to see the chat section?
I think your net is breaking. Again?
You can hear me?
Yes, I can hear you.
Are you able to see the chat section?
Yes, I am.
Oh.
Oh, you are not able to?
Just for checking, I was asking whether we can have a detail on specific balance which can apply specific materiality. Probably a demo or a detailed response can help.
Now, we said that this will be a matter of judgment based on, let me go back to where that was. We said this is a matter of judgment based on the risks that the auditor has identified, and they have gone ahead and identified that these are risks which are significant to the audit. And because of that, the auditor may need to set a specific materiality to that particular area. For example, it could be that you have identified that related party transactions during the period of COVID-19 were so many of them, and they have been identified as non-routine transactions, and therefore they are significant risk of material misstatement. And in that particular case, you might need to set a specific materiality for that particular area. As much as you had set materiality as a whole, and you had set performance materiality, now you need to set a specific materiality, which may be lower than even performance materiality for that particular area, because you want to focus on that area and get more or reduce risk to an acceptable level. So it will be a matter of judgment, professional judgment on the auditor, based on the discussion that we had somewhere and said that if you have identified that a risk is a significant risk of material misstatement, then you would need, let me go back to that slide. If you have identified that that's a risk of material misstatement, this is it. If you have identified that the likelihood and the magnitude of a significant risk of material misstatement is very high, we said then you need special audit consideration. For example, you've identified related parties as an example to have a significant risk of material misstatement, and therefore it needs special audit consideration. One of the special audit considerations would be to set a specific materiality level for that particular financial statement area. I hope that is well answered. And yes, you'll get the notes. So many people are asking if they'll get the notes. Someone is asking, are small entities required to prepare their financial statements using full IFRS? Now, what we can say is that yes and no. No, because probably regulation may require that they use IFRS for SMEs. Yes, because there's no limitation on using full IFRS. The only limitation is on using IFRS for SMEs, which specifically states that public interest entities cannot use IFRS for SMEs, which means an entity can be so large, but if it's not a public interest entity, it can still use IFRS for SMEs. An entity can have trillions of shillings in revenue, and somebody may think that it's so big that it should not use IFRS for SMEs, but there's no law that, or the IFRS for SMEs does not restrict it from not using it. But there's a restriction that a public interest entity cannot use IFRS for SMEs. Therefore, a small entity can use full IFRS, but a public interest entity cannot use IFRS for SMEs. Oh, I think you had also been answered by Jared Osoro. Thank you, Jared, answered that question. SME, that is entities that public interest entity. Thank you for that. Maybe we can go through the chat and see if there's anyone that we have not dealt with. Teresa says, great presentation. Thank you. Insightful, special last section on impact on COVID-19 and relating it to application of laws and statutory reprieves awarded. Okay. Can we have a specific balance? That one, I think we've dealt with it. CPA, you can also be scrolling to see if there's any that we have not answered. Let's also scroll through.
I think you've answered all the questions.
Okay.
Allow me, members, to thank our speaker for the good and detailed presentation. I don't see any other questions. So
Harun Mosop asks, how would the effects of COVID-19 affect the auditor's opinion on an entity's financial statements? I think we have dealt with that by saying that the COVID-19 pandemic has brought in new risks that the auditor will need to assess. And remember, from the first slide, we started by saying the auditor's objective in auditing financial statements is to obtain assurance that the financial statements are free from material misstatements, whether due to fraud or error. So it will then mean that the COVID-19 pandemic poses more risks that the auditor needs to assess in order to determine whether the financial statements are free from material misstatements. If they're not free from material misstatements, of course, you know the various types of opinion that the auditor can issue. They can give a qualified opinion, they can issue the adverse opinion, they can issue the disclaimer of opinion. So what it means that the COVID-19 pandemic risks will need to be assessed to determine whether the financial statements still are free from material misstatements, whether due to fraud or error, and have been prepared in accordance with the applicable financial reporting framework. Thank you. CPA, I think you can proceed.
Yes. There's a final question from Ndoro.
Yes.
From Kare Pundora and Associates. Now, maybe CPA, how can we perform our audit on management of controls during COVID pandemic?
Come again, please. I think you are, is it my net or your net? You are breaking.
He's asking.
Yes.
How can we perform our audit on a management override of controls during this COVID pandemic?
Yeah, we said, of course, there is a challenge because you'll find that most of the time, you may not be going to the client's premises to do some test of whether the controls in place are working and whether there are any controls that were overridden. But remember, still, the auditor's role is to ensure that you have obtained sufficient and appropriate audit evidence. Now, one such a way, of course, because the controls they may have done will, or the override may have affected the financial statements in terms of, for example, what is the policy of the company in terms of accounting estimates? Has the entity's policies been followed in determining the estimate? That's one way you can determine whether the management was biased or did not, it has overridden the controls in place. Number two is the test of journals throughout the year. You need to look at test of journals that were passed, sample of journals that were passed throughout the period, especially the COVID-19 period. You need to increase the number of journals you are going to test so that you can check whether there were any controls that management had overridden. Of course, there are also purchases that the management may have made. You need to look at whether the purchases they made were or followed the company's policy in terms of purchases. Because somebody may have decided that because it's COVID-19 pandemic and this is an emergency, let's make an emergency purchase. Was this emergency purchase later on ratified, for example, by the board? If a purchase beyond a given amount of money is required to be ratified by the board of directors, and was reason for having overridden the control provided, so that you can now be able to understand whether the control was in the overriding of the control was with the objective of committing a fraudulent activity, or it was reasonable in the circumstances. So there may be circumstances when the controls may have been overridden, but was this ratified after that? And you need now to inform or communicate to the management and those charged with the governance on how they should deal with such a pandemic or such a situation in future without necessarily overriding the controls in place. Because there are many entities that may have done such an override, because maybe the FM is not around and we need cash urgently. We'll need maybe to override some controls and make sure that this is happening. I think that is what I can say. But we've said the auditor will need to heighten their professional skepticism, including even what management will explain to you in terms of why the control was overridden. You'll need to get more explanation and get whether the explanation is sufficient, whether you need to carry out additional tests to confirm whether whatever they are saying is okay.
Thank you very much, CPA Samson, insightful presentation. Thank you for accepting to share knowledge with us and with our professional colleagues. I know for sure we benefited. We may not be able to cover everything in one session, but I know in the future we'll be able to plan for a detailed full financial audit so that we are able to do it fully. Someone is asking, of course, whether we are sending the notes. Yes, we'll send the notes. Another one is asking for a number, an emergency number. This pack. Yeah, it is 0719-074-000. If you call that number, you'll always be assisted, or you can send an email to member services at ISPAC. We'll be able to respond to. So members, it's now 10:31. We have 29 minutes remaining. We will break for, we'll have a we can now go for health break, then we come back at 11. Thank you very much for your time. Thank you for listening for the last 2 hours, and we hope that we'll be able to proceed as a team. And the last what I want to tell you before we even break, this is a continuous, it's like a syllabus. Don't afford to miss in any session because a session picks from the other. So if you miss one, you'll not be able to cover the syllabus. Thank you very much. Until 11, enjoy your health break. Thank you.
Okay, thank you too.